the biggest news on the market right now is interest rates keep on going up. Now, some of us who are investing, we see this trend that's coming. We know there's inflation, there's going to be interest rate hike in order to compound this. So what is the impact of interest rate going up? And do you have, nobody has crystal ball, but do you have a little bit projections of where the rates are going to go to? I think that's obviously an urgent question where everybody has in their mind.
Yeah, and that's a great question. Well, I used to, like I mentioned, I used to trade interest rates actually before in finance. So it kind of like, they have like a little bit of background. So I can relate to in 2020, for example, I can relate to the ahead of the COVID recession, quote, and very short recession, right? But still, like a very 1 quarter recession, quote. And so ahead of that, like one thing to note about interest rates that will happen is that the interest rates, the way we knew as finance professionals at the time and trading the market that, okay, we are in a recession that just hasn't been measured yet in like GDP, 2 consecutive quarters of GDP slowdown terms, let's say. But the way we knew it was, okay, it's the bond market had a huge rally. So interest rates sort of really plummeted like at the end of January and like beginning of February already. So the time was already, okay, it's looks like it's a recession, like such a huge bond rally heavily correlates with the recession. So that's like one comment on interest rates. So it's really, they're going up, but they were going up in 2018 with the Fed was hiking rates. And then in 2019, the yield curve inverted. And now the whole inversion has like all these other comments of, okay, what portion of the treasuries and yield curve is actually held by the Fed themselves. And then there was like an article right today, like New York Fed holds like, I think like around 38% of the 2 to 10 year treasury security. Oh, wow. But then it becomes kind of a question of, okay, what's the impact of that on mortgage rates? Now, if Fed holds kind of like a position in that, and like, should mortgage rates be even higher if they didn't, like, or something like that. But really like the interest rates side, so okay, in 2019, then the yield curve inverted. And interestingly, that yield curve inversion predicted, which historically has generally predicted recessions, now with the exception of Russian debt crisis in 98, for example, but the yield curve inverted, and then it did succeed to predict what it was a pandemic-caused recession, which, okay, how that works, I have no idea. Maybe it was random, maybe there would have been another recession or something like that, but it ended up also not failing just on the historical record. So 2019 inversion, and so after so there was an inversion and then sort of a bond rally into recession. So that's kind of the dynamic that, at least for me, is my baseline scenario now. So there are the rate hikes. So the treasuries, the 10-year treasury, then reflects those rate hike expectations, which I believe as of prior to April, the rate hike expectations were around 325 basis points total. Now it seems like they've been reducing a little bit. Like those expectations, but generally that's what happens. So rates go up with the Fed hiking rates, trying to sort of save the economy, but then they will hike rates only that much. And then the moment they stop, then the general trend, and of course nobody can predict the future, but the general expectation is actually rates plummeting in a recession. So that's something I say to my real estate investor friends, where they're like very concerned, okay, see if interest rates are gonna go forever up. But yes, they are going up now, but it's really what happens, such as rate hiking, rate curve inversion, subsequent bond rally, and then we're in a recession. So that's kind of like the usual cycle. And so that's like my personal kind of baseline scenario on interest rates in that sense.
Yeah, and then if we look at the 1970s, where the last time where inflation has gone up to the rate where it is right now, and then it took, some will say maybe that wasn't the reason why it went down, but it took Volcker, people always credit Volcker to be, helping with that inflation rate by hiking up the interest rate to, I think, almost 20% or something like that, right? In order to curb that. Some economy will say that was not the reason why it was curbed, but do you see that interest rate going up to that drastic measure, or do you think it's more going to be around 2 to 3% here now, going up to that point, and then it's probably might be enough because it would drive the economy down to depression?
I mean, it's hard to say. I think it's gonna depend on really, I guess, like if we start entering a recession or not, and like this kind of perspective. But it's really well, on that thing, let's say now what are the biggest predictors now of like the recession expectation that currently everybody has? Like it's the yield curve inversion and then consumer confidence, right? So those are the two that are very, now yield curve inversion is now in some models, they don't know how they derive the probability since they're having that many yield curve inversions in the past, but it's let's say 2/3 probability of a recession within 12 months and then 98% within 24 months, right? That was kind of like what was around the articles, like even like mainstream articles, right, on the topic. And so, but then there's another nuance to that, that the stock market historically peaked 3 to 12 months before a recession following a yield curve inversion. Now the stock market already peaked, don't hold me to that, but I think it's already 5 months ago at least. That was the peak. So unless we now get like some kind of reversal, which doesn't seem too likely, but never know, like then it could be kind of like 7 months ahead. It's kind of hard to say, but that's like, let's say very, just like if the history like exactly matches or something, it can be completely different as well. But generally it doesn't seem to be an overly long timeline for that. Now the rate hikes, there are like that many FOMC meetings or Fed meetings to happen. So the rate hikes, they really, could, we can have a few, and like they've been kind of planning to raise like with 50 basis points per meeting, right? So it's kind of could get to a certain level. It's hard to say. Like I wouldn't expect to get too high myself, but it's really hard to say. So
yeah, but it's really kind of interest rate hike is not really the biggest combat to inflation. What Fed's try to hope for is increase the interest rate high enough it affects the consumer, confidence, and also getting some of parts of the, let's say, real estate sectors, et cetera, come down a little bit more. And then it essentially would drive the economy to a depression. So the depression itself, and maybe it's a combat method for inflation, because that would slow down the economy and hopefully slow down the inflation over
here. Absolutely. And that is the case indeed, actually, in the 70s, actually, because when we had when there was a recession, like with the super high inflation at the time, and it didn't, it's not like the recession prevented inflation plummeted in the recession. So that's like the other thing, like with people being very concerned about either interest rates or recession, but they both tend to like, really go down once the economy kind of slows down. So this is like this is kind of my general like expectation, but of course it's hard to predict the future, but that is, my baseline scenario. Now mortgage rates is, many of like some of your audience might know mortgage rates are primarily tied to the 10-year treasury rate. It's like people, they don't hold their mortgages for 30 years, right? Kind of, and the 10-year rate is a pretty important rate in the first place. So it kind of like they correlate highs to the 10-year rate. So the 10-year rate has been responding to, to the rate hike expectations, and it appears perhaps those rate hike expectations subsided a little bit, and some of the probabilities, I think, reduced because 10-year rate pulled back recently to its level a little over a month ago. So, and with that, mortgage rates reacted a little less, and they kind of are a little bit less down than the 10-year rate is. So, so it's been, like this kind of dynamic. But now, of course, perhaps the general trend of interest rates is still up at the current time. But that is, like that's kind of the situation now. I don't know if they would go like way too high, like interest rates. It's hard to say, but it will stop whenever the recession. So, yeah.